Hi and welcome to my channel. Today, in continuation to our exam series videos, we are taking up a question on cash flow from operations, which is a question in one of the model question papers issued by ICMAI on financial management subject. So before we go into the question, let us just brush up our basics on cash flow statement. So cash flow statement has two methods of preparation. One is direct method, another one is indirect method. Now we will be considering indirect method now. The format will be like this. First we will have profit, cash flow from operations. There are three cash flows in a cash flow statement, three segments. So first one is cash flow from operations. Then we have cash flow from investing activities. Investments or investing activities. And then we have cash flow from financing activity. These are the three segments that we have, and we will add up all the net cash flows, that is from these segments. Whatever is if you add these three up, you will get net cash flow. To this net cash flow, we have to add opening cash, if we add the opening cash to our net cash flows, that is, this is the net cash flow, add opening cash, we will get closing cash balance. So the check that we have by preparing our cash flow statement is to ensure the closing cash balance that we arrive from our cash flow statement actually matches with the amount that is mentioned in the balance sheet. So we will see under cash flow from operations, what are the items involved, because cash flow from operations is the most important part of a cash flow statement. So we will start under indirect method. We start with profit before tax. To profit before tax, we adjust our non-cash items. That is non-cash items meaning depreciation, which does not have any actual cash outflow or cash inflow. Okay, it is merely for accounting purposes. So those kind of items we need to remove from our profit before tax to arrive at the actual cash profit, right? So we have to adjust it in, if it is a debit, all the debits non-cash item in your P&L account has to be added back. So debit in P&L, debit in P&L, non-cash, it has to be added back. And all the credit in your P&L, non-cash, has to be reduced. Okay. So non-cash items, basically it involves depreciation, bad debts written off, preliminary expenses written off, so any kind of write-offs, then profit or loss on sale of assets, sale of investments, So all these items are non-cash items which has to be added or reduced. This based on where it is in the P&L account, whether it is in the debit or in the credit. Then cash flows pertaining to other activities like investment activity or financing activity. For example, we have earned an interest. So when we earn an interest, it will come under other income. So it will be in P&L credit side. But the interest is earned out of one of our investments. In that case, what we do, we have to reduce it from profit before tax to arrive at the net cash flow from operations, and that has to be added under cash flow from investment activities. So any kind of movement pertaining to other heads has to be adjusted here. So this will be a minus cash flows pertaining to investment or financing activity. Cash, if it is a cash inflow. And what you have to add back? We need to add back any cash outflow pertaining to investing or financing activities, because that will be then it will be added here. It will be reduced in the respective heads. Then the last one that has to be added or adjusted is your net working capital. Net changes in working capital. Net changes in working capital. So we need to make one more adjustment, that is income tax paid. If there is any income tax that has been paid, we adjust that and then we get cash flow from operating activities. So this is an overview of how to prepare a cash flow statement. So to profit before tax, we add all the debit non-cash items, we reduce all the credit non-cash items, then all the credit in P&L pertaining to other activities, investment or financing activities, will have to be reduced. All the debits in your P&L pertaining to investment and financing activities will have to be added. So the same concept, all the debits need to be added back, all the credits need to be reduced. Then net changes in working capital, whatever is a net change, whether it is a plus or minus, accordingly we have to add or reduce. Then the last item is income tax paid. What is the actual income tax that is paid for the year? So that amount, if we reduce it, we get cash flow from operating activities. Then we take cash flow from investing and financing activities. Investing activities is your investments, that is sale and purchase of fixed assets and investments. What is the total sale or what is the total purchase amount, total inflow and outflow of cash. Financing activities, any loan taken, share capital, issue proceeds of share capital, all this will come under financing activities. Then interest, if any, has been paid on a loan. So adding all these three will get cash flow, total cash flow during the year. You add opening cash flow to this, you get the closing cash flow. Net changes in working capital. Now what is called as net change in working capital? Working capital is current asset and current liability. So net change in working capital is what is the net impact of cash in the because of the working capital changes. So working capital, we have current asset and current liability. So what is current asset? Current asset are debtors, bills receivable, all the short-term assets. And current liabilities are short-term liability like creditors, bills payable, etc. So when a current asset increases, what does it imply? When current asset increases, it means that that much amount you have not received, that much amount of cash you have not received. So if my debtor is increasing from 10,000 to 20,000, that means that for the additional 10,000 rupees, I have made sales. I have booked the revenue and arrived at my profit also. But I don't have the cash yet. Similarly, if a current liability increases from 10,000 to 20,000, that is my creditor increases from 10,000 to 20,000. That means my purchases have increased by 10,000. So I have made purchases. I have debited my P&L account, reduced my profit for accordingly. But actually, from cash perspective, the amount is still not out of my bank. So if a current asset increases, it implies that my cash is less compared to my revenue. The revenue that I have booked is higher than the cash that I have. So what we do is when there is an increase in current asset, we have to reduce from profit. Okay. Similarly, when there is an increase in current liability, we need to add to profit. We need to add to profit. So because when current asset increases, the revenue is higher, profit is higher, but actually I have not received the cash. So cash is lower. So if I have to identify what is the cash from operation from my revenue, I have to reduce the excess data that has come in because of a non-cash revenue being recognized. Similarly, when my current liability increases, there is an increase in current liability. So my expense is higher, but my cash is still even more higher because the expenses have not been actually met by way of an outflow of cash. So with this, we will try to solve this sum. So they have given profit made during the year and all debtor, prepaid expenses, bill receivable, all these are current asset and current liability. So they are testing our understanding on their net working capital changes and how we are taking it up. So net working capital changes. So how we will do this is first is income received in advance. What is an income received in advance? If an income is being received in advance, that means that we are liable to pay, so we are liable to provide goods or services to somebody else and he has paid the amount in advance. So an advance received is always a current liability. An increase in current liability means I have more cash in my hand. So I need to add this back. Increase in current liability. So that is first one is income received in advance. And what is the amount? It is from 500, it has increased to 600. So 100. So the next one is prepaid expenses. So my prepaid expenses have reduced from 1600 to 1400. So we will go with this here. So any increase in current assets, increase in current liability has to be added. So opposite, increase in current asset has to be reduced. Then decrease in current asset has to be added. Decrease in current liability should be reduced. This is the basis of calculating this working capital changes. So the second one is prepaid expenses. Prepaid expenses has reduced. If that means in 2021 I have incurred a prepaid expense of 1600, okay, but in current year it has reduced to 1400. So if it is reducing to 1400, that means this 200 rupees has been debited to my P&L account in the current year. But have I incurred this expense in the current year? No, this expense has been paid in the previous year itself. So there is no cash outflow, actual cash outflow happening because of this prepaid expense in the current year. So it is a decrease in current asset which has to be now added back. Prepaid expense, which is 200. Then debtor. Debtor from 80,000, it has increased to 95,000. So my debtors have increased, meaning the revenue is being recognized, but I have not yet received the cash. So should I recognize the revenue? I should not recognize the revenue if I need to calculate cash flow. So I have to de-recognize the revenue to the extent of 95 minus 80, 15,000. That is, so I am de-recognizing it, I am reducing it. Increase in current asset. So here, putting that are 15,000. Then bills receivable. Bill receivable is an asset. It has reduced from 25,000 to 20,000. So my assets have reduced. That means I have got more cash inflow. So I have to add because there is an inflow. Bills receivable 5,000. So my creditors have reduced from 45,000 to 40,000 because my creditors have reduced. What does it imply? It implies that I have paid more money. My creditors are reducing. So how have I reduced my creditors? I would have paid money to them. So I need to reduce it. Decrease in current liability. My bills payable has increased from 13,000 to 15,000. So my bills payable have increased. What does it imply? If it increases, it means that there is an expense, but I still have not paid it by cash. So to arrive at my cash flow from operation, I need to add the expense back. Increase in current liability. So 2,000. My outstanding expenses have reduced from 2,500 to 2,000. Outstanding expenses is a liability. I'm yet to incur the expense. I am not, it is outstanding. It is already due, but I have not paid it. Right? So that has reduced. So it is a decrease in current liability. Outstanding expense. It's a decrease in current liability. So I have to reduce it. So accrued income is a current asset and there is a reduction. So decrease in current asset, we need to add it back. Accrued income 300. Adding all these together. To 2,50,000, we add increase in current liability and decrease in current asset. We reduce increase in current asset and decrease in current liability. So this is our cash flow from operations. I hope this video was useful for you and you have got uh, a good understanding on how to calculate cash flow from operations as well as a general understanding on the indirect method of cash flow statement preparation. Do subscribe to this channel and stay tuned for more videos. Thank you.